The Fed decision is in. Will that affect our 2024 outlook? I'm Michael Smith, and welcome to the Lowdown. Hello, everybody. I'm Michael Smith, and joining us today is Kevin Lenox. Kevin, welcome back to the show.
Glad to be here.
Well, Kevin, we're going to talk about our bullish and bearish case for 2024. And just as we're about to talk about this, the Fed comes in with their decision. I think the street right now finds it a little bit more dovish than we were expecting. The Fed's basically going to pivot, meaning they're going to hold the line as far as further interest rate hikes. And they also laid out in the dot plot saying 3 cuts for 2024. Let me get your thoughts on that real quick.
So the dot plots, which is maybe gets too much attention,
Sure.
But it showed an increase from a number of cuts versus September, 2 cuts to 3 cuts, and there were 5 members that are calling for 100 basis points in cuts, so 4 cuts.
Okay.
So a decidedly more dovish outlook by the Fed. As we're doing this show, the presser is just starting with Jay Powell, so we'll see what comes from that. But the initial market reaction is positive. S&P 500 up 1%. Bond yields, both the 2-year and the 10-year, both down meaningfully. Oil up 1.5%. Gold up 1.8%.
Well, so
Get into what that means.
While the market cheers, right? One of the questions I have, and I'm wondering, what does this say about the underlying economic strength for next year? What is the Fed anticipating? What are they seeing? Sometimes it's, here's the smoke screen. What's really happening?
It's hard to get into their head, and the message changes, but the soft landing economic narrative is what has the most traction at this point.
Agreed.
And it's interesting how it's really shifted from the hard landing scenario, which became the base case from basically the 1st of August to the end of October.
Yeah.
And I was starting to get some calls from nervous clients at the end of October about the hard landing really working out. And then there's a complete reversal of the mindset and significant reduction or easing of financial conditions in November and so far in December, which has basically erased the tightening that took place from August through October. And if you remember, the Fed said that this is positive in that the tightening of financial conditions is helping to do the job of the Fed. So they don't need to raise interest rates further. So now that we have this significant easing, what is Jay Powell going to communicate in the presser? And then as the quiet period ends after today, what do the other Fed governors say in reaction to the sharp loosening of financial conditions?
Well, I think there's a perfect segue into getting kind of what we want to lay out is, the bullish case for next year for 2024. And then the bearish case. So why don't we kick that off on the bullish case? What do you make for that?
So the bullish case, or the soft landing narrative, just to put some bullet points around it. Mm-hmm. So we have at least modest economic growth next year with unemployment that stays steady. In other words, it doesn't materially increase from here. With that, the current disinflationary trend continues. Mm-hmm. And if we get that, then there's a mountain of debt that is due to be refied next year. It's like $2.8 trillion if we just want to go on the corporate side between investment grade, high yield, leverage loans, and commercial real estate. $2.8 trillion.
Which is why I think they talked about the rate cuts. That's the real reason I think he came out and said 3 rate cuts, because of that debt roll.
And that's why a lot of people are saying that rates staying higher for longer is BS, because the economy cannot handle it.
Well, the interest in our debt's higher than defense spending. It's the highest it's been, the highest of any budgetary item.
Yeah, if 2.8 trillion resets 200 to 500 basis points higher, we have a meaningful default cycle. That's taking place. So
I think that's a real deal.
Yeah. So it's very, very important that these CPI prints have been weak, but don't forget we've had a 23% decrease in oil prices.
Okay.
That has helped this disinflationary trend, and we'll see if that continues. I still think there's a fundamental structural case for higher oil prices, but as you know, it goes in a constant V formation. And since the last show in October, those leading indicators flipped within a couple of weeks. And as we've said for a long time in the show, you date energy stocks. You don't marry them.
Well, so one question I got for you, so let's kind of stay on the bullish case for a minute. We know that most of this year, the Magnificent Seven has been what's carrying the market. Until about November, you saw the market breadth widen to some degree, so large caps started to participate. If we get the bullish case into 2024, do we see the breadth of the market widening? Do we see more participants? I mean, I think it's a 14% difference in upside that large caps have over small caps. Do we start to see the breadth widen, or what are your thoughts on that?
It should. So the most encouraging thing that took place at the same time the market started to rally and financial conditions started to ease was cyclicals finally got a bid.
Okay.
And I look at cyclicals versus defensive stocks. And it's a sign of risk appetite, if you will, within the stock market. Stanley Druckenmiller has a great phrase: the best economist he knows is inside the stock market.
Yeah.
In other words, look at what sectors, what type of stocks are doing well and which ones are underperforming. So to see cyclicals take the lead over defensive stocks and even challenging tech stocks here recently, that's a very positive sign. And we've also seen some participation from small cap, which is also healthy. So as part of this rate tightening that we've seen, about 40% of all small cap stocks have negative earnings this year. That's a lot.
That is a lot. Well, now let's get to the bearish case.
Okay.
So where do we want to start with that?
Yeah, so there, the weight, if you will, the long and variable lag from the rate increases that we've had finally start to negatively impact the economy, and we start to see an actual contraction in growth alongside an increase in the rate of unemployment.
Yeah.
That would be negative. If that happens to coincide with sticky inflation, staying in the 3 to 3.5% range, that would take away the Fed's ability to lower rates. So in other words, they'd almost be facing a stagflationary type of environment there, where you have a weak economy that calls for rate cuts, yet you've got inflation sitting 100, 150 basis points above your target rate of 2%. That would be negative on top of the $2.8 trillion in corporate debt and commercial real estate debt that has to get reset. So just the longer that this higher regime of interest rates stays in place, more and more companies and more households are going to have to take on a higher level of borrowing costs, and that's obviously negative for the economy.
Well, in regards to the labor market, I mean, here we are before Christmas, and you're hearing of company layoffs. I mean, you talk about Christmas Scrooge. Usually you wait till the first of the year. So I'm wondering if the Fed is looking at, because obviously they're trying to keep, the dual mandate. Employment is very important for them, and they're already seeing that. And I think you and I talked last show about the warrants notice that companies file if they're looking to potentially lay off, and that was pretty high. So if it's already this bad before Christmas, it's like, well, what's going to happen after the first of the year in terms of layoffs? So that could be something on the Fed's mind, maybe why they're trying to put ahead, hey, we're planning to cut rates, 3 times. Maybe they're trying to get ahead of that. I don't know. What are your thoughts?
Yeah, so a couple things. There's a LinkedIn hiring metric that shows the percentage of LinkedIn members that announce a new job divided by the total members.
Okay.
And that has historically led wage growth by about 10 months. And that has been rolling over basically all year. So this sticky wage growth we've been seeing around 4% is likely to roll over. And the LinkedIn measure is consistent with the weaker labor market. And more recently, Korn Ferry, which is an employment agency company, staffing, they announced earnings, and their fee revenue was 3% less than last year for the second quarter, and they announced, I think, a $58 million restructuring charge, which includes realigning their workforce. Translation.
Yeah, realigning. It's a nice word.
So in other words, they think it's going to be a more challenging environment going forward, and since small business hires so many people in this country, and so many of the small businesses are more affected by the increase in borrowing costs, I think it's fair to assume that the unemployment rate ticks a little higher next year. This disinflationary trend, it's going to take a while to work out, and I think the worst case scenario is the Fed cuts rates because they think they're in the clear, and inflation stalls at 3.5%. In other words, they were premature.
Well, I was just going to ask you
And that's the rub.
Yeah,
and they
yeah.
keep getting whipsawed by the data and declaring victory too early, and only to wind up with egg on their face one more time. So that's
the bearish case. Now let me ask you the question: what are you feeling as far as the Fed's ability to pull off this soft landing? We know we have not had many soft landings in the history of recessions, right? We haven't had it. But I mean, it seems like that might be where he's heading. But what is your confidence in his ability, or Jerome Powell's ability, to do that?
It's not all just on the Fed here.
Sure.
I think they will act prudently. They have to act ex post. That's just, they will. But just, inflation runs in cycles.
Yes.
So it's not really so much going to be up to them as I think more structural factors in the economy that are going to determine really how this plays out. But the odds, if you will, would probably favor the harder landing side.
Well, we need more data, of course, right?
Pick between the two. The Fed would rather fight inflation and deal with, they would rather push against a recession.
Sure.
And take their chances with inflation if push comes to shove.
Well, I think that sums it up, and well said. And Kevin, as always, thanks for joining, and we'll talk to you here in 2024.
It'll be an interesting year.
Yes, it will. All right, thanks.